How the U.S. debt crisis affects us all. Every American is impacted by the U.S. debt crisis, which has an impact on everything from individual finances to the economy as a whole. The effects of the national debt's ongoing growth reach well beyond government balance sheets. They affect public services, borrowing prices, and economic stability. Navigating the future of the American economy requires an understanding of how this catastrophe impacts each and every one of us. Here are 7 key points that illustrate the widespread effects of the U.S. debt crisis. Number 7. Economic recession. A devastating recession might be brought on by a possible default on U.S. debt, which would have far-reaching and significant effects on the domestic and international economies. The government runs the danger of losing investors' faith when it defaults on its debt, which could result in a downgrading of the U.S. credit rating. Interest rates on government bonds and other loans would rise as a result of this downgrade, which would tell financial markets that the U.S. is a riskier borrower. Spending in the public and private sectors would probably decline significantly as borrowing costs increased. Companies may postpone or abandon their investments in new initiatives, which would lower economic activity and the creation of jobs. As households reduce their spending and grow more cautious about their financial futures, consumer confidence would also suffer. Reduced company investment and decreased consumer demand might cause the GDP to drop significantly, possibly by 4.6% or more. Millions of Americans would experience increased financial instability, a decline in income, and widespread job losses as a result. Number 6. Stock market turmoil. Since the stock market is frequently seen as a gauge of the state of the economy, a U.S. debt default may cause financial markets to experience unheard-of instability. A sharp drop in stock prices, maybe by as much as 45%, might result from investors quickly selling off stocks and bonds if they worry that the U.S. government will not pay its bills. Retirement accounts, college savings plans, and other investments that families depend on for their financial stability would be severely impacted by such a fall, which would wipe out trillions of dollars in household wealth. Number 5. Rising unemployment. The possibility of rapidly rising unemployment rates in a number of economic sectors is one of the most direct effects of a credit crisis in the United States. With rising interest rates making borrowing more expensive and consumer demand declining due to economic uncertainty, many businesses may have to reduce staffing or stop hiring entirely. A default or long-term fiscal instability is expected to result in the loss of about 8 million jobs. Businesses that are especially vulnerable to downturns during economic crises include manufacturing, retail, hospitality, and construction. Number 4. Increased borrowing costs. The immediate result of a U.S. debt default would probably be higher borrowing prices for both consumers and companies. To offset the increased risk of lending money, both to the government and to private borrowers, lenders would demand higher interest rates as trust in U.S. Treasury assets declines as a result of default fears. Consumers may see much higher rates on credit cards, auto loans, personal loans, and mortgages as a result. For example, mortgage rates may rise to about 8.4%, making homeownership more and more unaffordable for many Americans who are already struggling with growing housing expenses. Additionally, higher borrowing costs might hinder the growth of a firm. Number 3. Global economic impact. Because the dollar is the world's main reserve currency, and because U.S. financial markets are essential to international trade and investment systems, the effects of a U.S. debt crisis would be felt well beyond American boundaries. International trust in U.S. financial stability may be seriously damaged by a default, which would force governments and central banks to reconsider their investments in U.S.-based assets like Treasury bonds and stocks. Investors may seek safer alternatives for their money as a result of this change, which might cause capital flight from emerging markets that mostly depend on steady capital inflows from the U.S. This could result in more volatility overall. Because of this interdependency, A crisis in the United States could have an impact on global supply chains and economies across the globe. Countries that rely heavily on trade with the United States may also undergo economic downturns if demand from American consumers drops precipitously as a result of domestic recessionary pressures. Number 2. Consumer confidence decline. Consumer confidence, a key factor in economic growth in any economy, would probably fall significantly as a result of economic instability brought on by a debt crisis. People often tighten their budgets and cut back on discretionary spending on products and services like dining out, vacation, entertainment, and luxury goods when they believe that their financial futures are uncertain because of volatility in markets or growing unemployment rates. A vicious cycle is created by this drop in consumer confidence as more people directly experience job loss or lower income levels. Businesses cut back on spending, which forces them to reduce operations or lay off employees. This cycle then feeds back into further drops in consumer confidence. Businesses may limit their investment in innovation or growth plans as a result of the decreased demand for their goods and services, which would further impede efforts at economic recovery and lengthen periods of stagnation. Number 1. Long-term fiscal consequences. A protracted debt crisis has significant and varied long-term fiscal repercussions that influence not only the state of the economy today, but also the chances for stability and prosperity for future generations. The government may be forced to enact austerity measures if it is unable to adequately manage its debt obligations over time. These measures could include reducing funding for healthcare programs like Medicaid or Medicare, education funding, infrastructure development projects that are essential for economic growth, and Social Security programs that are meant to help vulnerable populations in times of need. Low-income families would be disproportionately affected by these cuts because they depend heavily on government support for necessities like access to healthcare and food security. Without these vital services during difficult economic times, like recessions, many families may find themselves in dire situations with few options for relief or recovery after crises gradually erode society's foundation. In summary, there are serious concerns associated with the U.S. debt crisis that go well beyond fiscal policy and affect consumer confidence, job security, economic stability, and international markets. It is imperative that policymakers give top priority to practical solutions that protect the economy and the welfare of the populace while the country navigates these difficulties. If you liked our video, please hit the like button and subscribe to our YouTube channel.